Well, good afternoon, everyone. Thank you very much for joining us, both those online and those facing us live today. I'm delighted that we'll be hosting this panel session, looking to explore, the new investors. So over kind of the next 30 to 35 minutes, we'll be looking to really understand what are some of these changes that we're seeing in client behaviours and what will the implications be for advisors and wealth managers. And then we'll get under the bonnet to understand this growing trend that we keep hearing about within environmental, social and governance investing. And lastly, we'll explore how technology essentially is going to shape that client-advisor relationship. I'll then open the floor for questions over the next 10 to 15 minutes. So I hope you all have the Brella app where you can submit all your questions. My name is Esg Investing. I'm a private client director at Esg Investment Management. And in my role, essentially, I provide investment planning advice for private clients. I'm so delighted to be joined by two excellent speakers, both Kanishk Swarap and John Ditchfield. Kanishk is a partner at St. James's Place, and he's a qualified financial planner and wealth advisor. He spent a decade working as an equity derivatives trader at Credit Suisse, JP Morgan, and BNP Paribas. And after enjoying a successful career in equities trading, he was invited essentially to join the St. James's Partnership. John Ditchfield is Head of Responsible Investment at Helm Godfrey. He's been a specialist in responsible investment for the past 20 years and is one of the UK's pioneers in the area of impact and ethical investing. He served as Director of the UK Sustainable Investment and Finance Association and has been a member of the admissions panel for the Social Stock Exchange, which was the first public market to list impact businesses. So welcome to you both.
Thank you. Thank you.
So let's get straight into it. We can all agree essentially that the fundamentals of any relationship rarely change over time. And I think building trust remains at the core. However, we've noticed that client behaviours do change. So in your experience, what do you think clients are looking for from their advisors or their wealth managers? And to what extent do you think this has changed over the last 5 years? I can start with you, Kenneth.
I think in my experience, right, I think there are a lot of things that clients can expect, right? And different clients have different needs, they have different situations. But one thing that I think is consistent across every single client is they don't want their advisor to be indifferent to them. So what I mean by that is they want to know that their advisor, whoever they are working with, is on their team, actually cares about their situation, actually understands their situation inside out, and is able to then give advice or give recommendation or suggestions which is completely in their interests. And I think that is something which is fundamental. And that has it has not changed at all over the years. What has changed, I think, in the last few years is with the advent of more online platforms and robo-advisory tools which are now available, clients just expect a bit more from their advisors. I think the expectation level has definitely gone up where, let's put it this way, they want their advisors to be far more proactive in their approach. They almost want, rather than being reactive where a client comes to an advisor and says, hey, this is my situation, and this is my problem, how do you think I should, what do you think I should be doing? They almost expect the advisor to take that first step and say, hey, listen, Mr. Client, this is how the budget has come out, these are the tax changes, and I think given your situation, this is what is relevant and why.
Yes. Anything you'd like to add there, John?
Well, I'm going to, what's the word for it? I'm just going to talk my own shop really, because what I really am enjoying immensely is the enormous shift towards, I think, what the industry calls ESG investing. I don't think any clients ever use that term. I've never had a client ask me for an ESG investment, but clients and investors, people, are more and more concerned about the impact that their money is having on the world around them. I mean, Richard Curtis, who is a illustrious filmmaker, actually he's made some terrible films, but he's made quite a few films, is now campaigning on the subject of pensions and ethics, So you've got all of this stuff washing around in the public discourse. We've got COP26 at the moment. There's a big outcome there around investing and financial markets. So that's pushing a lot of people to ask questions about their money, which 10, 15 years ago they would have asked them, quite possibly, and the wealth manager or advisor would have said, oh, well, the performance will be terrible, just ignore it. Or they would have said, oh, we don't do a green fund, so go away, or something like that. And that's been replaced by an industry which is really keen to service clients, and often quite wealthy clients. The people who've got considerable sums of money want to invest. They want to make sure those investments are aligned to some extent with their personal values. I suppose it's, if I wanted to be more perhaps a touch philosophical about it, you'd say that if you can go out and buy a pair of trainers that's exactly the colour scheme, my son's got a pair of trainers that's sort of exactly the colour scheme he wanted, exactly the laces he wanted, all of this. So you can get this very high degree of personal specification in consumer products, that kind of buying behaviour is moving across into investing behaviour, isn't it? And so people are saying, well, it's not good enough for me just to have a fund anymore. I want to really know what's in that fund. I want it to be an impact fund or a sustainability fund or a responsible investment fund or something like that. So going back to Ines' question, trying to draw the rambling to a close, I would say that a big trend that I'm witnessing is that sort of demand from private investors for a degree of understanding and a relationship with their investments that it was less in evidence, I can say. I think it's always been around, but it's certainly less in evidence.
Brilliant. And just touching on that point in terms of, this growing interest that we are seeing in environmental, social and governance investing, how do you think it's, transforming the investment landscape?
Shall I take this one? Why not, eh? So how is it transforming the investment landscape? So I guess you've got the consumer push. So anyone turning on the TV tonight or listening to the radio will be hit with news from COP26 about us being a minute to midnight, to use Boris's words, to use Greta's words, blah, blah, blah. But to use my words, more action from states and intergovernmental organisations around addressing an enormous crisis that the planet faces in terms of biodiversity, species loss, in terms of climate change and the problem of our use of the environment. So you've got this big news push, that's going to ask people to certain questions about their lifestyles, and they're going to translate that into questions about their money at some stage, Okay, so that's happening. You've then got the regulator. We can't ignore the regulator. We wish we could, but we can't. So the FCA, towards the end of 2022, will adopt some sort of green taxonomy in the UK. So that's already in Europe. So many of the funds that I deal with are already compiling data on their underlying investments to be able to comply with European regulation. That's coming here to the UK, so there'll be some sort of taxonomy in green investing. So that's changing the picture in terms of what the investment houses have to do, the kind of information they have to do. So yes, and the regulator, the consumer, so the industry's really got to find ways, and we're here to talk about technology, and obviously technology is a great way that those types of concerns can be communicated back to private clients. So there you go. The landscape is changing, one hopes.
Yeah, I think I would completely agree to everything that you just said there. I think previous to, let's say, in the last couple of, 5 years back, there used to be, let's say, one ESG fund with a wealth manager or a couple of ESG funds, and that's as far as they would go. And I think now what's happened is, I think post-COVID especially, clients want more, investors want more. It's not just good enough to generate returns. That's a given, right? You need to perform and the returns has to be there. But they want their money to go further. They want their money to be actually helping make the climate a better place, make the world a better place, make the world more sustainable. And I think what wealth managers are having to do is to fundamentally change the way they think about these things. And rather than just having a couple of funds which are ESG focused, their entire DNA in the way they select the fund managers, in the way they mandate their fund managers on what they are allowed to invest in or how they should be investing, needs to kind of incorporate ESG as one of their selection categories or selection criterias, which means that everything that a client would be invested in would have been selected through the lenses of ESG, which I think is a fundamental change that I've seen in the last couple of years.
Fantastic. And there's obviously this growing demand, but clearly there are challenges as well. And we hear issues around greenwashing. What do you think are some of, I guess, the kind of technological innovations that need to happen, or changes that we need to see in order to make this something more appealing for clients? But also, how does one client pick one fund manager to another?
So I think that's really hard, isn't it? I mean, the problem is it's extremely unstructured data. The investment management, so I run apart from working at Helm Godfrey, where I'm head of their responsible investment offering, I also run a research practice which actually looks at investment funds to try and get an understanding of whether this particular investment fund is genuinely sustainable, or whether it's another example of the industry's love of greenwashing their existing products. So that's what we do. But the problem is that the data that comes back from the investment fund manager is hugely unstructured. So it will be completely different from the last manager that you asked about their approach to engagement or climate change. And so it's very difficult to analyse. Now that's a huge challenge. Now I'm not a technology specialist. I've worked with some technology specialists in this area who are using that at the company level. One of my clients runs an ESG analysis business, so they get all their data from individual companies to help them manage their information. But when you take that up to a pension fund or an OIC or investment trust, it's very complicated, because you then have to do some sort of due diligence on the underlying companies, or do you just focus on the fund manager's process? It's really difficult. So tech specialists, we do need a solution. I mean, I was chatting to one of the chap from UCL who runs a data lab, full of PhD students in this area, and he was kind of nodding and saying, yeah, it's very unstructured and very difficult. So they don't have an answer to it. So I think potentially, if advisors can work with technology solutions in this area, there's some great opportunities to be had. I know that some companies are doing it and trying to find interesting ways of creating visualizations around impact, for example, relating impact metrics to graphical representations of the activities of the fund, this type of stuff. But it's still very early days in terms of technology solutions.
Yeah, I think from my standpoint as an advisor or a wealth manager, it's just there's no standard benchmarking, I suppose. I think that's the point you mentioned as well. Like, there are hundreds of funds out there which call themselves to be ESG focused, for example. But there is no standard. I wish that over the next couple of years we get this standard benchmarking, right, which is globally accepted, where every fund gets a rank from, let's say, between 0 and 100, gets a score, and then it's easier for investors and advisors to be able to put criteria to say that, I only want my clients to have funds which score above 80 or above 90. And I think that would be the big breakthrough, because right now it's very hard to measure how far one particular fund manager has gone versus the other.
Well, Morningstar had a crack at it, didn't they, with their Globes rating, but it's a complete dog's breakfast. So what happens if you use that is you end up with a fund that has Shell as one of its major holdings. So just briefly explain this. So Shell scores terrifically highly on ESG metrics because it's one of the world's largest companies, and it produces enormous quantities of data on its environmental performance. Yeah. So ESG is not a qualitative measure; it's often a quantitative measure of how much does a particular company say about itself. British American Tobacco, Shell, BP are all leading ESG stocks because they supply enormous quantities of data into the process. So a leading sustainability fund that I work with scored extremely poorly on Morningstar's Globe ratings because it held small US renewable energy businesses that didn't report a great deal of their activities to the market because they are by definition trying to achieve a shift away from fossil fuels, whereas Shell would score terrifically highly. So that's the the problem you've got is if it's just data that's driving the solution, then what's going to come out of that is an unsuitable recommendation for the client. And that's a problem for anyone who works in a regulated industry, because your recommendation should be suitable.
Yes, then I think with a lot of the clients that I look after, everyone's understanding or view of ESG will differ from one person to another. So I may care more about the environmental side, you may care more about the social issues. And I think the key thing is being able to, from a client, if I was sitting as the client on the other side, is looking at that fund and seeing how we're really able to demonstrate that with the funds that we're actually invested in. But as you say, it's definitely, if the technology is coming along, there's definitely that regulatory push, and equally there's that client demand. So it's definitely going to be an area that we'll see continue to grow. Kind of moving slightly differently and going into what we call kind of the cryptocurrency world, where we are in a tech event. I guess there's been a lot of conversation, and for me, for my clients, it's more curiosity than anything. How much do you think that cryptocurrency like Bitcoin is it encouraging more clients to invest or kind of engage with investing in general?
I think it's definitely caught people's imaginations, right? So I think what we have seen is a couple of things in the last couple of years. I think first, because of COVID, people are sitting at homes and have more time on their hands. So I think for the first time, let's say there are no sporting events, there's nothing you can bet on sports, and people have suddenly taken to the stock market as a natural substitute to have some fun. And I think that has definitely led to a lot of first-time retail investors over the last 18 months. Secondly, we have now had platforms, and the success of Robinhood in the US, for example, is a great one, where the apps have made it so easy and intuitive for people to understand how to trade or how to invest or how to put their money and buy something, whether it's a stock or a crypto, doesn't really matter, which has again really led to that shift where lots more people are now investing. And I think third is this whole crypto euphoria, where over the last 18 months or 24 months, people have just found this to be a way to express themselves, which is not controlled by the governments, and that has taken off. So I think, in my personal opinion, it's good. It's good in the sense that, like, US adoption of people investing in the markets is much higher, let's say, than in the UK. And it's good for people to invest. I think we can all fundamentally agree that it makes sense to be investing for the long term, whether it is in stocks or bonds or commodities, it doesn't really matter. But rather than holding your savings in cash and letting it erode in value due to inflation, it makes sense to be investing in the long term. And I think that concept is hopefully now much more acceptable because of what we have seen in the last 18 months. But on the flip side, just to finish off, it is extremely high risk. And I think that's where financial advice becomes extremely critical, because there's a place on how much to invest, where to invest. And I think people who do not have the experience and knowledge need to, in my opinion, get some advice so that they don't burn their fingers.
I would agree.
So I specialize in, so talking from a personal perspective as a wealth manager and advisor, I work on a relationship basis with private clients. My issue with a lot of this is it's fundamentally good relationships are built on trust. Human beings don't in general trust something that it's simply a website or is an online platform. So the extent to which there's going to be mass adoption of real money moving to these types of platforms, I'm not hugely convinced about. I mean, everyone gets excited about Nutmeg. They sold to, 600 million or something to JP Morgan. So there's obviously evidence that you can make it work. If you throw colossal sums of money at the wall for a decade, you can gradually build a business out of this. But I think there's always going to be scope for the kind of my colleague to my right, the kind of in-depth wealth management and understanding of your client that's there. And certainly to provide regulated advice, you need to have that understanding of the client. So the extent to which this sort of speculative activity is in competition with us, I don't believe it is. I think we can work with clients through education, through helping them understand that this is, as I say, speculation and very high risk. But it's certainly interesting. And I agree the point about the falling away of barriers to entry to investing. Anyone can pick up their smartphone now, and within 5 minutes they're an investor. Are they? Do they understand the tax consequences of what they've just done? Do they have a long-term plan for that? Are they going to be good at managing that over time? I don't think they are. I think what you'll find is that users of those apps at some point are going to need to speak to someone who can really give them personal guidance, or someone they actually trust to deliver support to them.
Yeah, and I think, as John mentioned, I think that's exactly what we are seeing as well on our side, right? There are increasingly clients who want to do their own thing. They want to have a kitty where they want to use these apps and have a go. But equally with, let's say, majority or their serious money, they want to take advice. They want to make sure they don't get it wrong. They want to make sure that they have all aspects considered and thought about before doing something.
Yeah, if you've just inherited £1 million, you don't go to a website, put in a username and password and transfer it over. That's just not how human beings behave, I don't think. I mean, there may
not
be...
Not yet, at least.
Well, maybe. We were chatting in the kind of green room before, and you've got a whole generation who are much more comfortable with the online space and with apps. So perhaps you will see more drift into that space. But I think there's always going to be a space for traditional wealth management, because fundamentally it's about relationships and understanding.
I think just one more point to add, like if you look at the last 10 years, for example, it's been the post-financial crisis period where in general markets have gone up in a straight line without, let's say, a huge shock till COVID happened. So people with recent memories, people who have, let's say, started investing in the last 5 years, I mean, with all due respect, probably felt that it's just too easy, right? You just buy, and this doesn't really, I mean, the analogy I give sometimes is, if property prices in general are going up, it doesn't really matter whether you buy in South Kensington or in Canary Wharf, because everything's gone up. But I think the real challenge comes when markets flatline or we had COVID. And I think, in fact, I would say the next 10 years, in my opinion, is not going to be as smooth as the last 10 years, because you're going to have some sectors, some areas of the world or the economy which are going to do extremely well. So technology being a great example, or e-commerce or logistics would fly because it's perfectly suited for the post-COVID world. But what about high street retail? What about oil companies, for example? What about banking in the traditional sense are probably going to struggle in the post-COVID world? So you're going to have this K-shaped phenomenon where investors need to be far more smarter about where they invest, rather than just blindly putting their money into anything.
Yes, and I would agree. I think, as we saw, on the onset of COVID, when things tend to get choppy in markets, as a client, you simply just want somebody to talk to.
That's it.
Just that reassurance. And, if you can't really communicate with something on a digital platform. And so I would agree. I think that plays a lot to a lot of the strengths within our industry. And so we've probably touched on this slightly, I guess, looking to the future then. Do you still believe that, that human interaction, those face-to-face engagements will still be much more important than, I guess, those digital interactions? And what are kind of the merits of both?
I think clients are agnostic to whether it is completely face-to-face or completely technology. I think it has to be a mix of both, in my opinion, right? I think clients want things faster. They want their requests to be actioned quicker. They want to be able to see things and understand things on their own. So I think just completely being reliant on face-to-face is not going to work. So I think the way I look at it is, the ideal model in my mind is where the client has the option to pick up the phone and speak to an advisor, whether it's on WhatsApp, email, phone, or Zoom, or whatever it might be. But equally, the advisor is using as much technology as possible to kind of make that experience much better for the client. So the client has all the tools available to, let's say, log in and look at their performance or analyze their returns or whatever, but they have the option to pick up the phone and speak to their advisor who really understands their situation, understands the history, understands the goals, and is able to, especially let's say in the when COVID struck, when the markets fell 20-30% in like 2 weeks or something. I think the value that was added to speaking, or the decisions that were made during those few days with the clients, is probably paid for like 10 years of financial advice, or paid 10 years of fees, for example, because of some key decisions that were made then. And most importantly, which was just hang tight, right?
Yes,
Don't panic. Don't make any emotional decisions, as hard as it might seem at the time.
Absolutely.
And I think that's the way forward.
Well, I think those are all very good points. I think it's remarkable that really advisors add more value by telling people not to do things more often than telling them to do things, really. That with someone who's reliable, on the end of an email or a phone call, who can say, just hold on, really, that adds an enormous amount of value. So obviously, I've consulted in these kinds of apps, trying to develop something online, and what I've seen is that they miss a key component. They miss the relationship. They miss that trust, and if you don't build that sort of trust, it's very hard to get commitment from clients, and clients aren't going to stay with a platform, especially through a 3-year bear market. I came into advising in the early 2000s, and there was a 3-year bear market around that period where equities did nothing, client portfolios typically drifted or fell well below starting value, and I don't know how someone's going to work with Nutmeg during that period, or why they're going to stay with an online portal during that period, because they're used to logging in, seeing the portfolio headed up, which is what markets have been doing since the financial crisis. So there's going to be quite a shakeout, really, I would have thought, at that period. And at that point, people want to sit down or meet via Zoom or some sort of telephone conferencing and have it explained to them that this is part of a long-term financial strategy, and bear markets or periods where equities fall year on year just happen, and this is the nature of investing. So
I think it's that questioning of that thesis again. So I think it's well understood that one should not try to time the market, and it's time in the market, and you should stay invested. But I think what people don't realize is that you should still probably test the thesis as to why you invested and why you are into something regularly. So you're not completely blind and being ignorant about what is happening in the world. And I think a lot of the conversations with clients is about that. Is like, yes, let's test the thesis. Why did we invest? Are the factors that we invested still the same fundamentally? And if so, then let's do nothing. So I think it's that ongoing dialogue which is extremely important. And also financial education, right? It's about, the way I look at my role is, I'm not there to just solve the problems for my clients and just give advice and manage things for them. It's part of my responsibility to give them insights from the world of personal finance, because they don't have access to it and they are too busy with their own careers, focusing on how to get promoted, how to get bigger bonuses, how to make more profits for their businesses. And I am the one responsible for their personal finances. So if I come across any insights which can help them understand the concepts better, then that's what I would do.
Yeah, no, absolutely. I couldn't agree more. I think the financial education piece is so important for clients really understanding part of that suitability piece. Why am I invested? What does this mean to me? How are we achieving those objectives? So yes, I would completely agree with that. Just looking at the time, we've got some questions coming in, so I will probably wrap up the discussion now and just go and take some questions from, I think, virtual and the audience. The first one essentially is kind of focusing more on what we were discussing around ESG. The FCA has released a discussion paper on the criteria to classify and label investment products, in that bid to help investors make more informed ESG decisions. How do you feel about it? Do you think this is necessary? Do you think it will help? I'll let you take that one, John.
Yeah, it's going to be an interesting one, this. So I've had a look at this and I know a bit about the EU taxonomy and how it functions. And the kind of smart view in the market for people who specialise in this area is it's going to get us some way, but it's definitely not going to get us all the way. So it's going to give very broad labels to funds. So you'll have funds that are categorised as having some responsible investment criteria that are noteworthy and could be promoted to clients. You'll have funds that are labelled as green or sustainability orientated. So there'll be these very general labels. So it won't lift away the burden of suitability or research that sits with advisors. It certainly won't do that. It won't allow the advisor or the wealth manager simply say, well, look, this fund has now been badged through this process as a sustainability product and therefore it's suitable for you. So the advisor will still have to understand these products. So I don't think the regulator is going to bring in a solution which is effective for the complexities of what private clients actually want in this area. Because private clients don't ask for, I want a fund with a solid track record in engagement, but I'm not so committed about its commitments to meeting the Paris goals. Clients don't frame their requirements in that way. Yeah, they'll come to you and they'll say, I'm interested in investing in a way that's environmentally sensitive. I still want to make a strong financial return, and I have a particular view about investments in China because I'm unhappy about human rights abuses in China. So my point there is the regulator will give us some very broad categories which will cause quite a lot of disquiet in the industry, I think, because they will be very broad. What clients want is something that doesn't really conform to those categories, and the advisor or whoever's doing the suitability work or helping the client obtain an investment solution is still going to have to do a lot of the analysis and explain all this to the client. So yes, it's a good thing. I think we need some more clarity, we need some more standardization so that the data that fund groups provide is in a more consistent format, and the regulator is headed in that direction. But it's not going to be a sort of, oh, well, we've done that now. Responsible investment's been dealt with because the regulator's given us 3 boxes and everyone's going to fit neatly into one of those. It's just not going to happen, in my view.
Anything you'd like
No.
to? Yeah, I would agree. I think, and when it comes to investing, as we said, it's personal. So it can't just be a tick box exercise. And I guess just following from that, do you still feel that your clients view ESG investing as their charity or goodwill pot? Or do they really see it as, these funds can actually outperform the market and do well?
I think it's the latter. I think it's definitely where clients generally and people I believe are now starting to just live in a way which is better for the planet. I think there's far more awareness. So it's not just about doing your quota and feeling good about it. But fundamentally, I believe this as well, that if you are investing in companies which are thinking about these issues as part of their DNA and in the way they probably produce their goods and services and the way they sell them to people, the market and the world will reward them for it. And I think Tesla is the greatest example for it. There's been hundreds and hundreds of articles about how their market cap, for example, dwarfs everything else by a country mile. But I would say that Tesla is being rewarded for their 100% focus towards doing things which is going to help the planet. Now, I would expect that trend to continue and people would be willing to pay a higher price or willing to pay more if they can see that the company is completely aligned to those initiatives.
Okay. What do you think, John? Do you agree?
Well, so my thoughts on this, yeah, okay. So humanity is on a course at the moment, a trajectory based on its CO2 emissions, which will make large swathes of the planet uninhabitable We're talking about mean temperatures similar to the Sahara Desert across areas that are currently cultivatable land and provide food for the world's population, which is headed rapidly up to 10 billion. Yeah, so there is very little doubt, you know, and all the scientific evidence supports a view that we are headed to something very serious in terms of societal change, yes, which is going to be compressed into a fairly short period of time, 30 to 40 years, yeah. Now, most people's investing timeline is 10 to 15, 20 years if they're talking about pension assets, yeah. So this is all really relevant stuff. The shift away from fossil fuels is happening. You know, you can't really doubt that. The UK generated 100% of its energy from renewables on a number of days just last year. You know, we are moving away from fossil fuels. Now, the fossil fuel industry is on the sort of sharp end of this, but you have other industries that are under severe threat. You know, their whole business models are going to need to shift in some way to try and accommodate greater resource scarcity, very different population concentrations in the world as people have to leave certain parts of the planet due to changing weather patterns. So, you know, this is hopefully sound, forward-looking investing. Yeah, we're paid to look ahead 10 to 15 years for our clients and talk to them about how their investments can be structured to deliver the right financial performance for them. So I suppose what I'm doing there is I'm not, you know, the question was posed as, is this charity or is it something that's planned to make a financial return? Well, I think the good thing about responsible investing is it can just be intelligent investing. You know, that's why I don't go to my clients and say, I'm going to hit you with a lot of, you know, I'm not a, you know, Greenpeace activist. I wasn't sat on the M25 earlier today trying to stop a lorry. You know, it's about sound investing and having an interesting conversation with clients about what the world's going to look like in 10 to 15 years, or the type of world that they want their children to grow up in. There we go.
I think clients are much more in tune in the fact that they can see that their capital can essentially affect change, as you say, rather than taking to the streets or chaining themselves up. And fundamentally, money talks, right? So if we see all this money coming out of the bad companies, then we have to see some change. I've had another interesting question come in, and I guess it's more about the emotional, the behavioural economic side of investing, where, you know, earlier we'd heard about GameStop. Do you see, you know, retail investors kind of making more emotional investments like this, or do you think they'll still be sticking to looking at fundamentals essentially?
I think who is to say what is correct, right? I mean, it's naive of us to, let's say, make a claim that emotional investing is wrong and just looking at valuations and reading the balance sheet is the right way to invest and that's how it should be done and that's the only way to make money. I mean, everybody is free to make their own choices. Everybody has different ideologies, different way of thinking, different way of analyzing the company. So I think I'm most happy about the fact that people are actually investing, right? People are actually making that first step, because right or wrong, if they do well, then they will be encouraged to do it more proactively, do it with a bigger portion of their savings, which is great. And even if they get it wrong, I feel they will learn from those mistakes. And you know, investing is not a one-year thing. It's something that you should be doing throughout your life, and then teaching your kids about it. And people will learn and improve. And if they feel that they are not getting it right because of their thinking, then they will take advice and trust specialists to do it for them. So that's what I'd say to that.
Yeah.
Oh, well, I think bubbles and bear markets and collapses have been part of investing history for hundreds of years, haven't they, really? Yeah. You know, I mean, human beings will make rash decisions on the spur of the moment, and when they get together, they'll share that view with a group of other people, and they'll all make poor decisions about money. You know, I don't, you know, the people don't really change all that much, do they?
No. Okay, as we're kind of reaching towards the end of this session, maybe, each of you can kind of give me, when we're looking at the new investor, the future investor, what are the kind of key things you think they will be needing or will want from their wealth advisors?
I think in my view, the key thing would be, I think I've touched upon this before, I think it's being far more proactive. I think I fundamentally believe to create wealth or to have a good lifestyle in retirement or to achieve financial independence, it is two fundamental pillars which is going to contribute towards that. One is your career, how much you earn, how much you make, and all of that. But equally important is what you do with the savings or with the income that you've actually earned and saved. And I find that across the board, on average, probably 90% of the time an individual spends is on their career, but maybe 10% or less on their own finances or to think about what to do with their savings. And I think that shift has to be 50% in an ideal world. And if you can't find that time, then you need to delegate it elsewhere. You get delegated to an advisor, you delegate it to a robo-advisor, whatever that might look like for you, but it cannot be ignored. And I think the people with the inflation that we are seeing, with the potential tax increases that we are going to see, that need is no longer a nice to do. It is a must. It must happen, and that is the only way people will be able to kind of stay ahead of the game. And I think advisors or wealth managers will need to make sure that that proactive approach is there to address those needs.
Yes.
Okay, so really quickly, so a couple of things. Well, I believe it's the case that the next 10 to 15 years we'll see a lot of money shifting towards female investors. I mean, the idea that investing is a male activity is kind of disappearing, perhaps. We'll see more women in control of their own money. I mean, the thing that's always struck me as quite amazing is the scarcity of female fund managers. I mean, I just can't get over it every time I go to a fund manager event. I mean, how many funds are actually run by women? It's an absolutely minuscule number. I think things have got to change in terms of the look and feel of some of the communication, perhaps, as that change takes place. We've already talked about responsible investment ad nauseum. I think that's a trend that's here to stay. I think it links to increased demand for information on products. I think people want more transparency when they buy a product now, and when they buy an investment product, that also figures. So I would say those are the major.
I think people want to understand what is going on. I think clients are not happy enough, I guess, to just say, here you go and you deal with it. It's okay if I don't understand it. They want to understand it. They want to feel comfortable about it. They want to feel confident about it. And I think that is a big responsibility on us, I think.
Yeah, and I think for clients, when I think about them, it's really that piece. It's the engagement side, that communication, that proactive nature, but also the service, right? And we'll all have great products, et cetera, but it's going to be that service or that relationship is why clients will pick you over John or whatever. But the great thing is, I think what we've seen is that clients have wanted to also become much closer to their investments and really seeing what they're actually doing and how they're impacting the world, and that's a great thing to see. I think for the new investor, it's about adopting that technology, embracing it, and seeing how it can really help improve those efficiencies. We've all done Zoom calls, meetings, etc. I don't think it will be the death of them going forward, but certainly it makes it easier for some clients who prefer that. Yeah. And it's as you say, it's finding that middle house. So as we kind of draw this session to a close, I want to thank everybody that joined us here today. Thank you for FinTech for putting over this great event for us, and thank you, John and Krashnik, for your insight as well. Thank you very much.
Thank you very much.